Hello, everybody. Thanks for tuning in. My name is Mark. I am the stock market jobber. My mission in life now is to teach people like yourselves. I assume you want to learn because if you didn't, you wouldn't be listening to me right now about how Wall Street really works. Now, I spent, make sure you subscribe to the YouTube page here. Um, anyway, I spent 2 decades in the institutional trading world, so I really know what happens. I was the head of trading at various hedge funds. I was a market maker. I used algorithms and Darkpools pretty much every day, just like a carpenter uses a hammer or a saw. Um, you know, Algorithms and Darkpools are tools that institutional traders use. So when I got into the retail world, when I decided to teach, I was really, frankly, kind of shocked. And to be honest with you, I still am kind of shocked about how many, rumor or misnomers or misinformation there is out there about what hedge funds are, what market makers do. Everyone thinks the hedge funds set out and the market makers set out to, rip off the little guy, but that's just not the case. So let me just kind of explain to you some of this stuff so I can dispel some of the things that you've probably heard that are wrong. Okay, first, hedge funds. What is a hedge fund? Is a hedge fund a monstrous oligarchical thing that goes to out to take advantage of the little guys? No. The only difference between a hedge fund and a typical institutional money management account or a mutual fund is the fee structure and who can invest in it. To invest in a hedge fund, you have to be considered what we call an accredited investor. And I'm not sure of the specifics, but you need to be worth a certain amount, or you need to have some kind of knowledge of finance. Not just everyone can jump in. But the big difference between a hedge fund and a typical asset management fund is the fee structure. Now, a hedge fund gets paid part of the action, a part of the profit. A typical hedge fund structure is what's called, say, a 2 and 20. You might have heard that before, a 2 and 20. That means the hedge fund gets a 2% management fee on the assets, and they get 20% of whatever the profit is. So, why do hedge fund managers that are good make a lot of money? Well, look at it this way. If you raised $1 billion and you had a 10% return, the 10% return is $100 million. So the hedge fund manager would keep 20% of that. They would get $20 million management fee. Performance fee, in addition to the management fee. Now, the mutual fund would just get the management fee of whatever it is. All right. So hedge funds can be really, really sophisticated, or hedge funds can be really, really boring. A hedge fund could be a buy and hold deep value strategy that trades once a quarter. A hedge fund could be, a high frequency fund. Now, I was the head of trading at 3 different institutional money managers. Under the umbrella of the money manager, there are different products that we had to offer. So the 3 money managers I was at, we had, say, mutual funds that an average or a typical retail investor can invest in, and we had hedge funds of different strategies. So, like I'll give you an example. One of the firms I worked at, we invested in a micro cap and small cap. So so we had micro cap, we had small cap growth, and small cap value. We had a mutual fund of each of those. There was maybe 50 or 60 or 70 stocks in each one. The portfolio managers picked the top 20 stocks that they thought were their favorite ideas or the best ideas, and they put them into a hedge fund. So in this money manager I worked at, we had 3 different mutual funds, we had 3 different hedge funds, and we had 3 different funds of those same strategies that weren't hedge funds or weren't mutual funds, but they were regular institutional or traditional institutional money management funds. So I am still kind of baffled about why people are so fascinated with hedge funds. Some places are standalone hedge funds. They're not. The hedge fund is not a product. Like when I was at SAC trading for the great Steve Cohen, um, I believe I could be wrong, but I believe that was just a pure hedge fund. Every product they offered was a hedge fund, or maybe they had just one product, which was invest in our fund, and it's a hedge fund. So that's it. Okay, it's hedge funds are not that mysterious. They can be boring. It's all about the fee structure. All right, the difference between a mutual fund and a hedge fund is the fee structure and who can invest. In order to invest in a hedge fund, you need to be what we call an accredited investor, which as a person, I don't even remember, but it's like you need to be worth like $1 million, or you need to have an income of over $200,000 or something along those lines. But the real difference is the piece of the action that the hedge fund managers get. That's why a hedge fund manager can make so much money. If they do well, they get to keep a piece of the action. Like I said, you raise $1 billion, you get a 10% return, which is 100 million. You keep 20% of that. You get a $20 million performance fee. All right, so that's it. That's what hedge funds are. Moving on here. Oh, market makers. What are market makers? Now, I know I can speak with authority because I actually was a market maker for 2 years. Now, in the trading world, you have people that manage money, like yourself. You might not think you're a money manager, but if you're a trader, you're managing money. And this is called the buy side of the market. The buy side is the firms that need to pay a commission to have a trade executed. If you're at a hedge fund, if you're at a mutual fund, if you're a retail investor, if you want to make a trade, you need to pay someone a commission to do it. The sell side, and I know it's a little confusing, buy side and sell side, because both the buy side buy and sell. I mean, the buy side and the sell side buy and sell. I don't know where the terminology came from, but if you ever hear people talking about the buy side, well, those are the institutions that need to pay a commission. You have to trade through a broker. That's the law. The sell side are the brokers. You need to trade through a broker. So when I was trading for a hedge fund, if I wanted to make a trade, I would have to call a broker. It could be Goldman Sachs, Morgan Stanley, whoever. All right. Now, market makers are traders that work on the sell side, and they specialize in a particular sector or particular stocks. For example, if I have to buy a bank stock, I get an order to buy 1 million shares of Bank of America, and I call up Goldman Sachs and I say, hey, I got to buy 1 million shares of Bank of America. Well, guess what? That would go to the market maker. The market maker is a team that probably trades, it's team or an individual, depending on the specifics, but they specialize, or that's what they do. They trade in and out of the bank stocks all day. So this is where the term market maker comes from. Wall Street's a big kind of, cat and mouse game, because no one kind of wants to let anyone know what else is doing. Now, if I have to buy 1 million shares of Bank of America and I call Goldman Sachs, they're going to try to feel me out. They're going to try to be like, well, what do you want to do? Or how big are you? What size do you want to buy? Are you a buyer? Are you a seller? Now, I'm probably not going to let them know, because I'd be afraid that, all right, well, they know I'm a big buyer. They have a seller on the desk, and they could tell the seller, listen, we know there's another buyer out there. If it's a firm that pays them a lot more commissions than the firm that I work at. So, it's this whole cat and mouse game, blah, 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 blah. So I would say to the market maker, I would say, hey, listen, put the market maker on the phone. And I would say, listen, I got something to do in Bank of America. And they would say, well, what do you want to do? And I would say, well, you got anything going on? And they'd be like, well, what do you want to do? Do you have anything going on? And I would say, do you have anything going on? Blah, blah, blah. It goes back and forth. And I would say, listen, man, I got something to do on 1 million shares. Make me a market. And I don't know where Bank of America is trading, but just say hypothetically, they might say, okay, I'll sell you 1 million shares at 21. I'll buy 1 million shares at 20. Because the market maker doesn't know what I want to do. But they just made me a market in Bank of America. That's where the term comes from. And the reason why market makers don't go out there and just try to rip off, Bed Bath and Beyond and AMC holders is because 98% of the time they're trading on behalf of their client. The client is the hedge fund or the mutual fund or the institutional money manager. So that's what market makers are. It's not mysterious. They're not evil. Hedge fund people are not evil. As a matter of fact, hedge funds managers are very philanthropic. I mean, I worked for Steve Cohen, who's one of the greatest traders in history, or money managers, and he donated tens of millions of dollars to the Stanford Hospital, the Greenwich Hospital. So hedge funds, fee structure, market makers, expertise in a particular sector. That's it. All right, let's move on to the next thing here. Algorithms. What is an algorithm? People say the algos are taking it up. The algos are taking it down. Well, that's the equivalent of saying the carpenter is using a hammer to nail a nail into a piece of wood. A carpenter is using a saw to saw through a piece of wood. Algorithms are just simply these computerized programs that traders can use, and they're used both on the buy side and on the sell side. Now, what is the most, like a really simple algorithm? I type in, all right, I'm going to go into my algorithm. I'm going to send this over to my broker, and real simple, buy 10% of the volume. All right? Regardless, stock goes down, stock goes up, you're buying 10% of the volume. At the end of the day, if a million shares trades, you bought 10%. You bought 100,000 shares. That's really the most simple. Algorithms can get very complicated. I could have an algorithm that says, all right, well, if I can buy my complete order, 100% of it at this price right now, just do it. If not, well, if I got a million shares to buy, well, never mind the amount of shares I have to buy. But if the price goes higher, I could program my algorithm to buy less shares. All right, if you can get everything at the current price, say the stock's at 20, just buy it. I got a million shares to buy it at 20. If you can't buy it at 20 and it starts going higher, well, let's buy 10% of the volume, or let's buy 20% of the volume. If it goes lower, we could say let's buy 30% of the volume. Let's buy 40% of the volume. If it's down by 10%, let's buy X percent of the volume. If it's up by 10%, let's buy X percent of the volume. So that's what an algorithm is. And some algorithms are good and some algorithms suck. And a lot of it depends on who is providing it. On Wall Street, for stocks, there's probably about 60 different venues where things trade. And I could have an algorithm from one provider, and I can have an algorithm from another provider, say algorithm B. So we got A and B. Algorithm A might only be hooked into a couple venues, so it's not going to be able to access a lot of liquidity. Algorithm B might be linked into a bunch of different venues. So it could provide more liquidity. Now, my forte was small cap and micro cap equities. So a lot of times that stuff is illiquid. So, it's like if you can buy it all at the price you want to buy it at, a lot of times you would do so. You wouldn't screw around. You wouldn't try to get cute and get a better price. Now, I could use an algorithm from one provider and I could type in there, if possible, buy me all, complete this order at this price. And I could send it to one algorithm and, maybe I buy 100 shares, 500 shares, 1,000 shares, because it might not be linked into all these different venues. Another algorithm might be linked into 30 different venues. So I say, if you can buy it all right, just buy it. And all of a sudden I put the order out and the shares just start coming in. Now, why does this happen? Well, the different trading venues, sometimes they're competitors, so they're rivals, so maybe they don't want to give access to another firm or another marketplace or venue. Yeah, to be perfectly frank, I don't even really know. I just know which ones I just know how it works. Like for example, Morgan Stanley and Goldman Sachs are competitors. So Morgan Stanley might say, "Hey, Goldman, can we hook into your, trading venue?" And they might say, "No, screw you. You're my competitor. Why do I want to help you?" Right? And but maybe if a hedge fund comes along and says, "Hey, can I hook into your your venues?" They would say, "Oh, well, the hedge fund is a client. They pay us commission, so we're going to give them access." So that's really what algorithms are. I think it's funny when people say algorithms are taking the market up or algorithms are taking the market down. Well, yeah. I mean, when you place an order with your broker, it goes into an algorithm. It's just a computerized thing it's a tool that's a computerized thing that just gets trades executed. All right, so next and last, the dark pool. It's like Darth Vader. Dark pools are not evil, they're just are. Okay? A dark pool is basically like a private stock exchange. If you're at Goldman Sachs and you're executing, hundreds of millions of shares a day, you would say, well, you know what? Why are we paying the New York Stock Exchange or the Nasdaq money to execute our trades? Why don't we just start our own particular stock exchange? That's why we have so many venues. When I first started doing this, 20, 25 years ago, 95% of what traded was either on the NYSE or on the Nasdaq. Now the market is so fragmented. This is why we have these big, moves and volatility, because sometimes these markets are linked in, sometimes they're not. Like, look at it this way. Say you want to buy a pair of shoes, and there's 20 shoe stores in the town. And you go into one particular store, and they say, all right, well, we'll sell you these shoes at $100. And you say, fine. Well, maybe another shoe store out there would sell you the same pair of shoes for $95. But you're not going to know that because you're not linked in. If all those shoe stores became one store, you would be able to know what's the lowest price someone wants to sell those shoes for, what's the highest price someone was willing to pay for those shoes. So kind of going back to the algorithm, sometimes things are linked, sometimes they're not. Now a dark pool is a private stock exchange. It's like, hey, if your firm does enough volume, why would you pay someone else to execute your trades? You could just execute them in-house. Now, I think the reason why people think dark pools are so, evil is because of the term dark. But it's kind of a funny thing. Around 20 years ago, when they first started marketing dark pools, right, when the brokers would come around and tell us buy-side people, hey, we got this dark pool, the whole thing was like, the whole pitch was, you can execute your trades and no one's going to see them. It's dark. It's a dark market. But it turns out that that's a complete myth and a misnomer. Every trade that gets executed, regardless on whether it's on the New York Stock Exchange or it's in the dark pool of Goldman Sachs, it has to get reported to the tape. It has to print. So as traders, we look at all the trades that go by on the, we call it times and sells, and whether the trade is executed in a dark pool or in, a lit market like the NYSE, it's going to be reported. So they pitched this whole dark pool concept with this like, oh, well, hey, man, you could trade and no one's going to see what you're doing. But it just didn't work out that way. That's not the way the laws work. And now people hear dark pool and they think, oh, it's dark. It's got this sinister thing going on. All right. So anyway, that's it, everybody. That's what hedge funds are. Hedge funds just have a different fee structure than typical funds. Market makers specialize in a particular sector usually. For example, the bank stocks. Algorithms or tools are just computerized programs that traders use to execute their orders. And dark pools are private exchanges that are owned by various different firms that are big enough that they could actually have their own exchange. So that's it, everyone. Please make sure you sign up to our YouTube page here, stockmarketjobber.com. Check out our website. Actually, our YouTube page is, Stock Market Jobber on YouTube. You can find it. And our website is stockmarketjobber.com. So that's it, everybody. Hopefully I dispelled some of the myth for you, and I hope to see you soon.